Now speaking, Rob Cost, Director, Investor Relations. The Kroger Company reported strong first quarter results for 2023. Net earnings increased 8.3% to $2.1 billion, while sales rose 7.7% to $37.6 billion. Adjusted earnings per share grew 16.4% to 93 cents. The company's digital sales also saw significant growth, increasing 122%. Kroger made investments in its operations to further enhance its customer experience and expand its e-commerce capabilities, resulting in a 70 basis point margin compression year-on-year. Looking ahead, Kroger expects to continue to invest in its business and drive long-term growth. The company remains focused on its mission to serve America through food, inspiring connection, and creating a better future. Now speaking, Rodney McMullen, Chairman and Chief Executive Officer. Kroger is off to a strong start in 2023 with results that reflect the strength of its go-to-market strategy. Despite challenging economic conditions, customers are continuing to prioritize spending on food, and Kroger's value proposition is resonating. Investments in productivity improvements have allowed Kroger to sustainably invest in price for customers while maintaining margins. Customers are actively looking for ways to save, leading to an increase in sales made on promotion and digital coupon redemptions. This has resulted in 8th consecutive quarter of household growth, with mainstream and higher-income customer households growing as they migrate from specialty retailers to Kroger. However, budget-conscious shoppers are buying fewer items, particularly due to SNAP benefit declines. Inflation levels are moderating, particularly in fresh categories. However, customers will continue to feel the effects of inflation and higher interest rates. Kroger is well positioned to meet this environment with its attractive value proposition and investments in fresh, our brands, personalization, and seamless, which create a full, fresh and friendly customer experience. Fresh is a key differentiator for Kroger, and the company is constantly innovating to improve the customer experience through data and technology. Home Chef has expanded its menu to include more healthy choices, premium meals, and new concepts, and AI is being used to simplify the digital experience and offer more accurate personalized recommendations. Digital engagement has grown, leading to a 13% increase in digitally engaged households. Finally, Kroger is committed to training its future leaders and was recently selected as a 2023 SEAL Business Sustainability Awards winner for its progress in creating communities free from hunger and waste. Now speaking, Gary Millerchip, Chief Financial Officer. Kroger's first quarter results demonstrate the success of their value creation model, delivering value for customers, investing in associates, and creating attractive returns for shareholders. A key component of their go-to-market strategy is identical sales without fuel, which achieved 3.5% growth this quarter. Underlying growth would have been 5% after adjusting for Express Scripts termination effect. Their FIFO gross margin rate, excluding fuel, increased 21 basis points compared to last year, primarily attributed to strong Our Brands performance, sourcing benefits, lower supply chain costs, and the Express Scripts terminated agreement, partially offset by higher shrink and promotional price investments. Digital sales grew 15%, with 11% growth in pickup and 30% growth in delivery solutions. Gross margin was 22.3% of sales. OG&A rate increased 14 basis points, excluding fuel and adjustment items, reflecting planned investments in associates and the effect of the Express Scripts termination. Adjusted FIFO operating profit in the quarter was $1.669 billion, and adjusted EPS was $1.51, both up 4% compared to last year. Health and Wellness team delivered positive ID sales growth despite Express Scripts effect. Fuel reward engagement saw a 19% increase in discounts redeemed compared to the same quarter last year. Alternative profit businesses are growing due to Kroger's food, health, and fuel businesses. KPM announced a new collaboration with Disney to bring its targeting and measurement capabilities to Disney's portfolio of connected TV. They also recently announced a rollout of cooler screens in their stores. Kroger continues to generate strong free cash flow, and they expect adjusted free cash flow to be in the range of $2.5 billion to $2.7 billion for the fiscal year 2023. They expect identical sales without fuel to be at the low end of their guidance range of 1% to 2% for the remaining 3 quarters of 2023, reflect continued slowing inflation, partially offset by underlying improvement in unit growth. Adjusted EPS is expected to grow within their full-year guidance range of 2% to 5% in each of the remaining quarters. Now speaking, Rodney McMullen, Chairman and Chief Executive Officer. Kroger's pending merger with Albertsons Companies. Integration planning has been progressing well and is expected to close in early 2024. Kroger is actively working to identify potential buyers for any stores that need to be divested in order to gain clearance for the transaction. Kroger has committed not to lay off any frontline workers or close any stores, distribution centers, or manufacturing facilities as a result of the merger. Kroger is also striving to address inaccuracies and misrepresentations about the merger. They are focused on delivering lower prices and more choices to customers and growing households and customer trips, which will position them well for long-term growth. North Coast research analyst Chuck Cerankosky inquired, what role do CPGs play in Kroger's promotional activity and how much of it is from Kroger's own gross profit dollars? Rodney McMullen replied, we are actively engaging in the process of helping households stretch their budget. We are targeting offers and promotions to individual households, with CPGs heavily investing in national brand items. Supply chains have become more robust, leading to an increase in product availability and CPGs focusing on tonnage. Our targeted promotions are funded by Kroger, which has enabled us to increase tonnage while maintaining our margins. We are pleased to be able to help people on a budget while supporting our own business interests. North Coast research analyst Chuck Cerankosky inquired, Rodney, what was the dollar amount of the 30% increase in digital orders and how much of that growth came from Ocado-related CFCs and spokes? Rodney McMullen replied, the majority of our total overall revenue will come from our sheds. Our partnership with Ocado has been great and we've made significant progress in ramping up the Monroe facility. We are now applying those learnings to the other sheds. Gary, any thoughts? Gary Millerchip replied, Chuck, to put it simply, our digital business is growing impressively. We announced 2 years ago that it had reached $10 billion in total sales and in the last quarter alone we saw a 15% growth on top of that. Morgan Stanley analyst Simeon Gutman inquired, could you tell us more about the price investments and promotions you've been making? Is this a one-time response to the competitive environment or a permanent change that will be sustained for the foreseeable future? Rodney McMullen replied, and some of it's because of the CPG funding. Gary Millerchip replied, we're seeing customers with different needs and behaviors in the current environment. We are leveraging our personalization for higher-income customers, engaging them more with fresh products and brands like Private Selection, which outperformed our overall sales growth during the quarter. For customers on a constrained budget, we are providing personalized offers to help them manage their budgets better. Morgan Stanley analyst Simeon Gutman inquired, what elasticity have you observed with price reductions, and at what point do you anticipate consumer wallets will be relieved of inflationary pressure enough to stimulate demand? Rodney McMullen replied, our historical data shows that when inflation is low, tonnage increases. We anticipate this trend will continue throughout the year, though exact figures are too early to predict. We're seeing strong market share growth, especially among mainstream customers who are less affected by price fluctuations. SNAP customers, however, are making changes to their shopping habits, such as buying smaller quantities more frequently. We still expect inflation for the rest of the year, just at a lower rate than what we've seen recently. UBS analyst Michael Lasser inquired, given the lower end of your full-year comp guidance, do you expect IDs to be negative in the back half of the year? What has changed within the updated expectation, especially regarding grocery? Gary Millerchip replied, thanks, Michael. As I mentioned in our prepared remarks, we expect the identical sales for the final 3 quarters of this year to be at the low end of our range. This is in line with our original guidance of 1% to 2% excluding Express Scripts or 2.5% to 3.5% including Express Scripts. We're not suggesting that the full year will be at the bottom end of that range, it's specific to the final 3 quarters. UBS analyst Michael Lasser inquired, can you confirm that each quarter will be positive and that tonnage must increase? Gary Millerchip replied, we expect positive identical sales in the last 3 quarters of the year, and a decline in inflation to more normalized levels. Grocery department sales remain higher than normal, but we've seen an improvement in unit trajectory which is helping to offset some of the decelerating inflation. During the first quarter, our ID sales didn't decrease as fast as inflation did, which allowed us to see some gains. UBS analyst Michael Lasser inquired, what investments is Kroger willing to make using its own P&L to address market share losses to price-leading players? Rodney McMullen replied, Michael, our household growth and market share with mainstream and upscale customers remain strong. However, we are not as happy with our price-sensitive shoppers on a budget. To better support this segment, we've analyzed our go-to-market strategy and determined our total value equation is competitive with EDLP merchants. We offer a different approach to shopping through pack product sizes, promotional activity, ads, rewards programs, and personalized offers. Additionally, we have introduced SmartWay, which is our brand focused on entry price points. Bank of America Merrill Lynch analyst Robbie Ohms inquired, Gary, could you please explain the FIFO gross margin assumptions ex-fuel for the next 3 quarters and how investing in price first, promotions and shrink could offset the margin? Gary Millerchip replied, Robbie, while we don't typically give guidance by line in the P&L, quarter 1 is a good proxy for what we expect in the rest of the year. We're focused on delivering value for customers and remaining competitive, however, we anticipate continuing headwinds from shrink in the center of the store. Our brand sales growth, mix improvements, innovation, and Express Scripts are tailwinds to our gross margin rate, but the GLP-1 product sales offset some of that impact. Additionally, we are seeing strong performance in supply chain and double-digit growth in alternative profits, which will be a continued tailwind to the model. Overall, we expect similar impacts and drivers in the remainder of the year as seen in Q1. Bank of America Merrill Lynch analyst Robbie Ohms inquired, "Can you provide an update on FIFO gross margin, ex-fuel, compared to the first quarter?" Gary Millerchip replied, "I agree that our focus is to balance the model, and I believe you are interpreting correctly." Bank of America Merrill Lynch analyst Robbie Ohms inquired, "What margin benefits do you expect to see from increased penetration of our brands, and how will promotional activity affect overall margins?" Rodney McMullen replied, "Our brands' margins are typically 600 to 800 basis points higher than national brands. This quarter the margin was higher than usual, due to increased sales of private selection products which customers love for their unique quality and style. The Smart Way line has a lower margin, but when all pieces come together it is still margin accretive, and we will continue to leverage our own manufacturing plants for added efficiency." Gary Millerchip replied, "In terms of growth for our brands, we anticipate increased customer engagement. We've seen a higher penetration rate during challenging economic times, and that has remained even after the economy stabilized. We don't have a specific target, but anticipate that customers will continue to find value in our products." Wells Fargo securities analyst Ed Kelly inquired, "Could you quantify the benefit that the GLP-1 drugs are providing to the ID, and what is the impact of the Express Scripts business on in-store sales?" Rodney McMullen replied, "The margin on that other drug is virtually non-existent. Our pharmacy teams have done an outstanding job helping people identify alternative networks and discount cards to help retain a large percentage of ESI customers. In over half the cases, we've been able to save customers money. It's been hard work, but it's ultimately paid off." Guggenheim Partners analyst John Heinbockel inquired, "Can you provide us with an update on the performance of your mainstream, upper income, and budget segments? Are there any differences in terms of growth transactions versus items per basket?" Rodney McMullen replied, "Our mainstream customer is performing slightly better than expected. The percentage of our upscale customers is comparable to that of our value customers. However, the profitability of our upscale clientele is much greater. We are seeing strong positive growth in our mainstream customer base, and negative growth with our value customers. Despite this, our total household growth remains positive." Guggenheim Partners analyst John Heinbockel inquired, "What is the current perception of the value proposition versus EDLP that customers have?" Rodney McMullen replied, "John, customers understand fuel rewards offers and appreciate the value they provide. However, certain customer segments are more budget conscious, so stocking up on items for discounted prices is not always possible. To better serve these customers, we introduced Smart Way and other programs to ensure they can still receive discounts." JP Morgan Chase & Company analyst Ken Goldman inquired, "What strategies have you implemented to maintain profitability and margins during this disinflationary environment compared to the deflationary environment of 2016 to 2018? Rodney McMullen replied, "Competition in our industry is intense, and that's not a bad thing. We're constantly working to create value for our customers, associates, and shareholders. This year we are expecting to reduce costs by over $1 billion, and we will continue to look for process changes to drive that number higher each year. We are also investing in improved product offerings which provide better value and experience for our customers. All of these factors give us confidence in the long-term sustainability of our model and ultimately benefit our customers, associates, and shareholders." Gary Millerchip replied, "I think Rodney summarized it well. Our business model has become more diverse, with an emphasis on increasing alternative profit sources. COVID has enabled us to better personalize the value we offer customers. We are able to leverage the power of our 84.51 data science business to save customers both time and money." BMO Capital Markets analyst Kelly Banya inquired, "What is the impact of health and wellness outside of Express Scripts on total comp and transactions in Q1, and what is the plan for the rest of the year?" Rodney McMullen replied, "Overall, the impact of sales on our business is greater than the margin it generates. Our teams have done a great job retaining customers in the GLP-1 space, and we expect that trend to continue for the rest of the year. However, the effect on profitability is limited." Gary, do you have anything else to add? Gary Millerchip replied, "Rodney mentioned it well. Our PBM change didn't have as dramatic an impact for us as some others, but it did provide a tailwind to sales during the quarter. The benefit in gross margin rate we saw from Express Scripts was largely eliminated." BMO Capital Markets analyst Kelly Banya inquired, "Can you discuss what's driving budget-conscious consumers to prioritize shelf prices and how your strategy may need to change in order to better connect with this customer segment?" Rodney McMullen replied, "We are committed to our Smart Way brand and have implemented it to better serve our customers. We have adjusted our product offerings and merchandising strategies, and created entry-level price points for items that matter most to them. Additionally, we have utilized our own plants to meet their needs. Oppenheimer and Company analyst Rupesh Parikh inquired, what expectations do you have for the promotional backdrop for the remainder of the year, given supply improvements and potential competitive pressures? Rodney McMullen replied, I believe the current market situation is largely supply-driven, with some categories still constrained. Most CPG companies have their supply chains back to normal, with just a few exceptions. We're examining promotional offers to gauge customer reaction, and I'd say the market environment is largely back to pre-COVID levels, where customers are making offers rather than it being a more promotional atmosphere. Oppenheimer and Company analyst Rupesh Parikh inquired, what have been the quarter-to-date trends you've observed? Rodney McMullen replied, quarter-to-date, our identical store sales are in the middle of the range that Gary previously discussed. Rodney McMullen replied, thank you all for your questions today. Before we close, I'd like to recognize our longest-serving associate, Mary Tennant. Mary has been with us for 65 years and is still going strong at 85 years young. She's worked in almost every role at her store in Moundsville, West Virginia, and her enthusiasm and dedication are inspiring. We're proud to have Mary as part of the Kroger family and thank her for building a career with us. Thank you all for joining us today and have a great summer. That concludes the call.